the lie we still live in. In 2008, the global economy collapsed. Banks failed, jobs vanished, homes were lost. And then, something strange happened. The system didn't break. It was rescued. Trillions of dollars appeared overnight. Executives walked free. Markets recovered. But here's the paradox. If the crash was fixed, why does the world feel more fragile than ever? What if the biggest financial crisis in modern history was never actually solved? The promise of stability. Before 2008, the financial world sold a comforting story. Banks were safe. Risk was controlled. Markets were self-correcting. Think of the economy like a massive airplane. Banks were the engines, governments were the pilots, and regular people were the passengers. We were told, sit back, relax, we've handled the turbulence. But under the floorboards, something was leaking. By 2007, U.S. household debt had exploded. Mortgage loans were being handed out like candy, even to people who clearly couldn't repay them. Yet the system kept smiling, because the numbers looked beautiful. How the machine really worked. To understand the crash, imagine this. A baker sells bread, but instead of selling bread once, he sells claims on future bread, then sells those claims again, and again, and again. That's what banks did with mortgages. A home loan wasn't just a loan. It was chopped up, bundled, repackaged, and sold as a safe investment. These bundles were called mortgage-backed securities. Rating agencies stamped them with AAA. Investors around the world bought them. Pension funds, governments, banks. It was financial alchemy. Risk went in. Safety came out. But here's the trick. Risk wasn't destroyed. It was hidden, like sweeping dust under a rug and selling the rug as clean. Then the housing prices stopped rising. People missed payments. Defaults spread. And suddenly, no one knew what anything was worth. Banks didn't trust each other. Lending froze. The financial system seized up like an engine without oil. September 2008. Lehman Brothers collapsed. Phones rang non-stop. Screens flashed red. Executives watched decades-old institutions die in hours. Governments panicked. If banks failed, everything failed. So they made a decision. Not to fix the system, but to save it. Trillions of dollars were injected. Interest rates were slashed to zero. Central banks printed money on an unimaginable scale. The crash stopped. The world exhaled. But the disease remained. The world after the fix. The rescue came with a message. Too big to fail. Banks learned something crucial. If you're large enough, if you're connected enough, you won't be allowed to fall. Meanwhile, regular people learned a different lesson. Losses are private. Bailouts are public. Wages stagnated. Asset prices exploded. Homes, stocks, and education became unaffordable. The gap widened. Central banks kept interest rates near zero for years. Cheap money flooded markets. Speculation became normal. Every bubble since then, tech stocks, crypto, housing, traces its roots back to this moment. The system didn't reset. It doubled down. The unsettling truth. Here's the uncomfortable reality. 2008 wasn't a glitch. It was a warning. Instead of redesigning the plane, we just patched the wings mid-flight. Debt is higher. Risk is bigger. Faith in institutions is thinner. The crash they never fixed is still unfolding. Silently, slowly, every day. So here's the question. When the next crash comes, and history says it will it be another rescue? Or will this time there be nothing left to save? What do you think was the real cost of saving the system? Comment below.